Do you want to retire stress-free and never worry about the stock market again? Imagine living off of a reliable stream of dividends without constantly monitoring your portfolio, stressing over interest rates, or reacting to daily headlines. Well, in this video, I'm revealing 4 elite funds that I believe you can buy and literally never sell. These are dividend machines with strong balance sheets, defensive business models, and inflation-beating dividend growth underpinning them. And with the right allocation, a $1 million portfolio of these funds can spin off over $51,000 in passive income today, which should be enough to retire comfortably in many parts of the country, especially when paired with Social Security and if you have a paid off home, etc. And remember, these dividends should grow at a rate that meets or beats inflation over the long term in aggregate. Before I get into the video though, if you like deep dive investing videos that help you grow real inflation-proof income, make sure to tap that like button, subscribe to this channel, and comment below with what's in your own forever dividend portfolio. Also, I'm currently running a 20% off discount at High Yield Investor, which is my top rated investing group on Seeking Alpha. We cover all sorts of dividend stocks and funds there and help investors put together portfolios of attractive and growing passive income from dividends while also generating market crushing total returns over time. Hope I can see you on the inside there. Let's go back to the video now. So first of all, why even take the buy and hold forever approach? Well, for many this can work, especially if you want to be able to just sit back and relax and enjoy your golden years, because then you don't have to spend all this time obsessing over the markets. Instead, you can just set it and forget it. Also, if you know that you may pass away soon or there's a high risk of you doing so, this can set you up to pass on your portfolio to your heirs without having to worry about whether they know what to do with it or not. You can just let them set it and forget it and continue to live off that passive income. Additionally, remove sequence of returns risk. You can just sit back and let the dividends flow in and not worry about where your portfolio is currently valued at the moment, which obviously, as we've seen recently, that's valuable because the market can crash at any minute and crash quite hard. Okay, so that's the case for buying and holding. What about these 4 funds I've talked about? Well, the first one should be no surprise. I've discussed it in previous videos. It's the Schwab US Dividend Equity ETF. And the reason I like it so much is it has about a 4% dividend yield today, has a 13-year dividend growth streak with about a 10 to 11% dividend CAGR over that time period. Its expense ratio is just 0.06%, making it one of the cheapest ETFs in the marketplace today, especially for dividend funds. It has over 100 blue chip holdings, making it well diversified across multiple sectors. And so as a result, it's good for a core holding in a dividend growth portfolio, especially when on passive mode, because you can just trust that the dividends will continue to grow over time. You get an attractive current yield, and it's well diversified and defensive in nature, making it easy to understand and very low maintenance. So as a result, this is an ETF I'd feel very comfortable leaving to a family member who knows nothing about stocks. It's that reliable. Okay, what's the second fund? Well, this one is not an ETF. It's not even a CEF or a mutual fund. It's actually a limited partnership, but it's effectively an infrastructure hedge fund. It's Brookfield Infrastructure Partners. Now, BIP is one ticker symbol that issues a K1. BIPC is another one ticker symbol that issues a 1099. Now, BIPC is more expensive than BIP, and BIP is not designed to generate UBTI, so you can hold that in a retirement account, not have to deal with the K1 and not worry about UBTI. But if you want to hold it in a taxable account and you don't want to deal with the K1, then perhaps you're willing to pay up for BIPC. Now, why do I like BIP so much right now? Well, it has about a 6%, actually over 6% forward distribution yield. It's backed by Brookfield Asset Management, which is one of the leading alternative asset managers and arguably the best infrastructure investor and operator in the world. And BIP pretty much engages in buying stakes in various infrastructure investments that Brookfield holds in its institutional investor funds. And so it's really a hedge fund. It's buying all these stakes in different infrastructure assets and businesses and then monetizing those stakes opportunistically and recycling the capital into other stakes to continue the compounding process for unit holders. And over time, pays out a very attractive distribution from those profits and grows those distributions at a mid to high single digit pace over time while growing the underlying cash flows of the overall combined stakes at a double digit CAGR for the foreseeable future. And that's what analysts expect. That's what management has guided for. On top of that, it's very well diversified across geographies all over the world, as well as industries. It has transportation, infrastructure like ports, railroads, shipping containers, toll roads. It has regulated utilities. It has midstream infrastructure, and even also has a rapidly growing data business that is positioned to benefit from the AI boom megatrend, particularly its data center businesses. And so with this large diversification and the asset rotation that it does, along with applying leverage at the asset base level instead of at the corporate level, has only minimal leverage at the corporate level. It removes long-term bankruptcy risk, which makes it a good buy and hold investment. And that capital rotation, the active management, the expertise, again, makes me very comfortable leaving it with someone else who doesn't know much about investing to hold for the long term, especially because it has such a consistent track record of paying its distribution and growing it over time at an inflation beating rate over the long term. Also has a BBB plus credit rating. The vast majority of its cash flow is either inflation hedged or inflation linked escalators. So again, inflation resistant, making it resilient across all sorts of economic environments. So it's really like the infrastructure version of Berkshire Hathaway, pays a very attractive dividend. And that makes it, in my view, a set it and forget it powerhouse, and happens to be trading at a very attractive valuation right now as well. Main Street Capital Corporation. Now this one is a business development company, which is sort of like a closed-end fund in that it holds a broadly diversified portfolio of underlying loans and equity positions in middle market businesses. And then the shares of that portfolio you're investing in trade with volatility on the public market. So at times it'll trade at a premium, a small premium, or a discount, or an expanded premium relative to its underlying net asset value. And so that makes Main Street Capital sort of like a closed-end fund. But I like it as a buy and hold forever investment because it has a very attractive, close to 7% dividend yield. It has, when you include the special dividends, it pays out regularly. It pays out its dividends monthly, so you can get over 0.5% dividend per month paid out. It's internally managed, so it has lower fees than many of its externally managed peers, has an investment grade balance sheet, has very attractive net debt to equity ratio of well under 1 times, which is one of the strongest balance sheets in the space. It has a large amount of exposure to senior secured loans on top of its equity investments. That makes it one of the more safe, gives it a little bit more of a defensive structure. Its consistent dividend payments and growth over time at a pace that meets or beats inflation, again, makes it an attractive, a long-term investment. Management has been very good at issuing shares at huge premiums to net asset value to grow the book value per share and the dividend per share over time. So that also makes it a great long-term buy and hold investment. Ultimately has an incredible long-term track record of crushing the market and the broader BDC space over time. So again, that gives me the confidence to hold it over the long term, even with someone who doesn't know much about investing, because I can trust management to look out for my best interests. Okay, and the fourth and final fund is ticker symbol RQY. It's a high yield real estate CEF run by Cohen and Steers. Has an attractive about 8% dividend yield. It currently trades at a pretty big discount to its underlying net asset value. Yet, despite that, it's been battle tested through the COVID crash, through rate hikes, through commercial real estate headwinds. It's continued to pay out very stable and attractive dividends through all that. And that's due to the active management that it enjoys under Cohen and Steers. They use a prudent amount of leverage to enhance that yield and also to generate market-beating total returns that have significantly outpaced the broader REIT space over time. And so again, that gives me a lot of confidence in the management over time. And again, it's really nice to include with its other 3 funds because none of them hold much real estate exposure. On top of that, it gives a boost in the yield to the overall portfolio, help me get more dividend income. And I happen to think that REITs right now are very deeply discounted, and they should actually benefit from this trade war because they're mostly domestically focused and they're more defensive in nature, so better positioned for a recession, and long-term interest rates are falling, and so that's a big tailwind for REITs as well. So there you have it. Those are the 4 funds: SCHD, BIP, MAIN, and RQY. Now, how you allocate these into a specific portfolio really depends on how big your portfolio is and how much income you need versus how much you want to err on the side of income growth. But if you're retiring today with $1 million and you want to make sure you're getting at least $50,000 in passive income, I think a pretty good breakdown would be 50% to SCHD because of its diversification, its conservative structure, its strong long-term dividend growth. Then layer in some BIP, maybe 17.5% or 175K into BIP, maybe 15% into MAIN or 150K there, and maybe another 17.5% into RQY. That'd give you to about $51,375 in passive income just at today's valuations. Now, market crashes can make that go much higher. And so, depending on what the prices are and when you're buying in, when you're seeing this video, perhaps the yield is even higher and you're getting more closer to $55,000 or even $60,000 on that money. But regardless, it's pretty well diversified across a broad swath of sectors. It's high yield, it's inflation beating dividend growth, and it's very passive. You can trust these management teams to look out for your best interests and not have to really closely monitor them at all. So whether you're a passive investor, a near retiree, or just want to sleep well at night, these 4 funds, especially in aggregate, can form the backbone of a retirement portfolio that prints reliable cash flow through all sorts of environments, year after year, decade after decade. And you don't need to get rich trading with it. It won't make you rich, but if you get wealthy and you compile wealth over the long term through disciplined investing, hard work, and saving, this could be your reward to just live off of a portfolio like this for the long term. Again, if you like this video, please give it a like, subscribe to the channel to get more content like this, and let me know in the comment section below what some of your favorite ETFs and other types of passive income funds are for set it and forget it investing. And again, don't forget, I've got that 20% discount going at High Yield Investor. Hope to see you on the inside. See you next time.